Welcome back. In this video, we're talking about, for the first time, Palantir 2028 leaps, meaning long-dated options, are now available, and they are available for January 2028, which is over 800 days from now. So to the extent you want to be leveraged long Palantir, this is the video for you, because we're going to be talking about how shares, common stock, has the linear exposure, no expiration, simpler to hold through volatility, and has many benefits both tangibly and I would even say spiritually when you're comparing it to options. But leaps, these long-dated calls, are more capital efficient, definitely more advanced, not for everyone, and convex upside if PLTR compounds into 2027, beginning of 2028. But the premium and expiration risk is real. So why Palantir long-term? We all know this. The platform, the AIP flywheel, this is going to be very important in the next couple years. To the extent you believe this is I would say $500 to $1,000 stock, you're probably going to get much more upside in leaps, but that's what we're going to be looking at and figuring out today. That growing commercial mix and stickiness is going to come to the forefront, and we're going to see how it's going to affect investors' confidence in the future. So volatility is not a thesis break, but I certainly expect a lot of normal volatility for Palantir in the long term. Upside volatility is great. The only volatility people complain about is to the downside for the most part. So bottom line up front, then we're going to dive into the modeling of the options, is bullish and patient. Shares are simple and resilient, and good on you. If you're bullish and seek that convexity, the leaps amplify the upside with less cash. It's as simple as it is. If you have to put less cash in, you can put the same amount of cash and amplify and get more, right, for what you're putting in. So you want to match the instrument to the thesis that you have on the stock and your temperament. So only you can decide. I'm not advocating for you to buy leaps. I just think it's an interesting thing we're going to be looking at and seeing if there is real opportunity. This is my first time going through it, so let's have a look. So here we are on Robinhood, PLTR buy call for January 2028. And let's have a look at what the highest strike that they are selling is. Looks like it's about $280. We would probably want to look for something that's going to have a bit of volume. These just came out, so they're not really going to have any volume open. I more so meant open interest, but yeah, I mean, very little. This is a new chain, and let's have a look at what 200 open interest is. Yeah, again, very low. So it's not great to always buy right away at the beginning of when there's wide bid-ask spread. That will fill in over time. So I guess for now we're just going to have to go with what we have here. So let's have a look at 250. It's selling for, the ask is $41 per share. Leaps are a high conviction bet on PLTR, but you still need to manage risk around them. Visual Sectors provides that explainable set of rules: factor selection, risk-adjusted sizing, and backtests, so you know why a trade is right. The idea is to generate uncorrelated, steadier returns from a market-neutral selection while your leaps ride longer-term catalysts. Even large managers run EMN, such as BlackRock, whose equity market-neutral fund, aiming for consistent returns with low correlation, credits that strategy to their performance through volatile quarters. It's backtested and positive every calendar year across bull and bear markets. Takes under 1 hour per week to manage, and individual investors are generating returns like 17% in 1 month. Keep your leaps sized for your thesis and use a separate rules-based long-short book to target steadier cash flows month to month. And the link is in the description for you to get the engineering-backed way to manage your risk and start your free trial today. So I love to look at this little simulator right here. Of course, you can do the math in your head as well. If you think Palantir is going to get to $350 per share by the beginning of 2028, then that is the stock is going up 100% from where it currently is, meaning doubling, and you would get a profit of $5,800 and that's going to be more than a doubling of your $4,100 that goes in. So if we do the math on that, I think, let's say we're buying, that's right. So it's the $41 has a 100 multiplier because each options contract commands a 100 share lot, and so they express it to you as per share, but you do have to purchase in 100. Each contract is commanding 100 shares. So there would be an outlay of $4,000, and if you think the stock's going to double, what's going to happen? Well, you're going to get about 150% return. So you get like a 50% extra on these leaps. Now let's move a little further up here. Let's say I wish there were, sort of shows where the market makers think the stock might end up, that they're not printing any higher options, at least for now. But we can move a little bit lower and see what things look like here. So the outlay would be about $5,500 for controlling interest in 100 shares, purchasing those at $200 per share. What's going to happen if the share goes to $300? You're going to get about $4,000 in profit. These are safer strikes. So this is sort of what we're looking at for now. I don't see huge opportunity, mainly because these options are, as you can see here, the break even is pretty low. So you would like to buy a break even that's high, and you have high confidence it is going to break even because the cost is going to be lower. But for now, I can see the upside. I would like for these to be cheaper. I think they will probably get cheaper over time. The bid-ask spread will tighten. As you can see, the bid-ask is pretty wide. We have $200 of a spread. So as more people buy into these, you'll be able to see, and whatever happens with the stock as we close out the year and maybe the stock trades down, maybe there is a much larger opportunity. But for now, I think you are getting a little bit of upside, a little bit of ample upside. I personally would hold out. I personally would not be buying these now, but you do see how it does reflect some upside, and there is the cash efficiency, which is great. But I'd love to know what you're thinking in the comments if you're going to be buying leaps at all, especially this far out, because you get that much of a time benefit. And certainly you're paying for that premium time duration. But I'd love to know your thoughts and what you expect going forwards. Until next time.